Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry educational webinar on reviewing and recapping the main events through 2022, as well as some forecast predictions and expectations for, of course, the coming year, that is 2023. So, as of course, we are ending the year of 2022, just coming back from the holidays break and starting out this new fiscal and business year with tons of opportunity to come. It's always good to have a solid understanding of the macroeconomics and fundamentals that have been driving the market, as a lot of the events from previous can give us signals of what's to come, whether we're going to see events or whether those events have been priced in and they're going to be left into history now, right? So we're going to be doing a bit of a review from about mid 2021 all the way to the end of 2022 and what we can expect to see, as we'll be giving the primary example on gold, but also applying the same type of logic and understanding to our other currency pairs and asset classes that we trade, such as the US stock market as well. We'll look at US dollar individually and so forth, right? Now, 2022 was quite an eventful year from an economic and fundamental perspective. We had various factors coming into play that were impacting the markets at one time or another, but I can primarily break it down into what I see as 3 or 4 main driving factors that held weight to the majority of asset classes through the market. Now, what I mean by that is, obviously, you have various fundamental catalysts on a daily perspective or weekly perspective, such as economic data reports that can hold weight for a session or a day, or some reactive catalysts like somebody in politics passing away that can have an intraday impact, or something along the lines that we saw with currency interventions that could have an intraday impact. But what I'm talking about is what was holding the most weight for investors, smart money, and the whales, where they were adjusting their order flow accordingly, that led to order flow moving in singular fashion across majority of asset classes. And with that type of focus, I mainly see 3 or 4 main information driving factors. Just a quick review now. So you can obviously see the chart. We're just sitting on the gold chart here. Basically, as we were starting out 2022, we were coming out of this phase where a lot of the fear, uncertainty, and doubt regarding COVID itself and the pandemic was priced in. Society was becoming more adjusted to it, and the markets were, of course, very adjusted to it. Also, what we saw was that a lot of the pumping of money into the markets, low interest rates by central banks, and of course, the rich getting richer, this was also starting to phase out and dissipate by the end of 2021. Don't forget, the pandemic started very early in 2020, which led to the initial crisis and crash, and the stock markets in majority of asset classes had a pretty sharp recovery and continued upside rally when you were looking at crypto, stock market, gold, oil, housing market, and so forth, as of course you had very low interest rates and the central banks pumping the markets and the whales riding that wave, right? This was what we primarily saw going into 2022 for this period here, you can say. So in this period in blue, just the last couple of months of 2021 going into 2022, we had COVID fears priced in, new variants no longer impacting markets, lockdowns phased out, sharp recovery and rally. And I'm primarily looking at gold here. And the example I'm giving about interest rates and things of that nature, I'm talking about the US economy and the example of the Federal Reserve. But this can also be applied when we're looking at the majority of other countries and their central banks, such as the Bank of England, Bank of Canada, Reserve Bank of New Zealand, Reserve Bank of Australia, and so forth, as they really followed suit with the Feds from the start of the pandemic to pretty much the end of 2021 going into 2022. You can also see, even if we're zooming out further here, this was when we had the pandemic going on, all of the money pumping into the markets, all of the fear, uncertainty, and doubt. And you can see that easily extended into the end of 2021. But then we started to have more of that information being priced in, of course. As we had more of that information priced in, a lot of the low interest rates information priced in, markets adjusted accordingly, fear of COVID dissipated, no major other fundamental catalysts in play. You can see during that period of entering 2022, we remained relatively stagnant on the higher time frames, staying in a range for a period of months until we started to go into 2022. Now, we started 2022 out with a relative bang in the essence of fundamental catalysts. For those of you who remember, early into 2022 is where we started to see Russia versus Ukraine tensions come into play. Now, Russia invading Ukraine isn't anything historically new, but it is a new event that brought a lot of market impact during that period of time, especially when global economies were already more on edge and the markets were more on edge, obviously dealing with the pandemic and the impact of that over the course of the last year and a half and 2 years prior from 2020 onward. But this phase here, where we're going to mark out in green from really the start of 2022 to around April, this is what we're going to break down as the war phase. COVID done phase in the essence of how it was impacting the markets. I'll do a different color here. We're going to call this the COVID complete phase, money pumping complete phase. And we're going to call this the war phase. Now, as the majority of information regarding COVID, such as all the new variants, Omicron, Delta, whatever other variants came out, was no longer holding impact, as the lockdowns were faded out, as we had the majority of central bank actions in terms of holding a loose monetary policy already priced in and adjusted accordingly. What was holding the most weight from the start of 2022, pretty much until we had that information priced in, was Russia starting to invade Ukraine. Brought more market fear overall, more demand in gold, revisited previous highs, failed to break higher. And it was a pretty adjusted process where you had the talks of Russia wanting to invade Ukraine, the actual invasion starting to take place, the damage to infrastructure, all of the bombs and so forth, as we peaked these highs again at $2,000+ an ounce roughly. During this time period, stock markets were a tad bit more bearish, yen was holding more weight, and your risk currencies such as GBP, euro, and so forth were also a lot weaker. Risk currencies weaker, JPY stronger. USD was still holding solid as a safe haven currency and world reserve currency, and still stabilizing after all of the money printing and low interest rates as that information was priced in, and more demand in gold, right? Now, this was all perfectly fine and dandy, but a lot of people were expecting gold to push a lot higher, not understanding that, yes, Russia invading Ukraine is a major global event and was also starting to lead into rumors of World War III, other countries getting involved and so forth, but it never went past the point of just being an invasion of Ukraine by Russia. Yes, there were sanctions during this period. Russia invading, sanctions on Russia, bombs going off, rumors of World War III, and so forth, but it never escalated past that. What I mean is we didn't have other countries such as countries in the Eurozone or countries in North America, more specifically talking about the US, actually get involved on a physical front to escalate it into a World War III scenario. Or we never had Ukraine join NATO to push the bear that was Russia, to poke the bear that was Russia even more and escalate the situation even more. Russia invasion, that got priced in, sanctions, bombs, rumors, all of that got priced in, but we never escalated past that. Now, what I want to explain there is, of course, that the invasion of Ukraine is still actively going to this day, but the markets always move ahead of the curve and start pricing in events and information so they can have an edge, an advantage on other market makers, whales, traders, investors, competitors, and so forth. This is where the whole pricing in concept comes from. This is why we see the money markets always move ahead of the real world economic impact, and that information gets priced in accordingly. The only way we would have saw gold, in the example of looking at gold here, push higher than previous highs at around 20.50 an ounce is if we had escalations that were well past the 2016 invasion of Ukraine. It's very well known that Russia has invaded Ukraine before. It's very well known about the various airstrikes, bombs, and the procedures that occur during any type of war or military dispute between two countries or an invasion. It's very well known countries get sanctioned in terms of their business, their companies, and so forth. None of that information was escalating past that point, right? We didn't have any actual World War III takeoff. We didn't have Eurozone or UK start sending military troops. We didn't have any, we didn't have the US get involved from a military standpoint. We just had all of the money that was made by the rich through the pandemic, through the sales of vaccines in the billions of dollars, through the money made in the market, through the money made in investment, corruption, and so forth. All of that money was starting to get laundered through this Ukraine catalyst, as these European countries and countries like the US were just providing a lot of funding support and weapon support, not actually sending their military or getting involved from a physical front. So we really saw that the impact of Russia invading Ukraine only lasted really about 4 to 5 months, starting from really late 2021, where the rumors were coming into play, starting to escalate in 2022, and really fading out by April 2022. Now, keep in mind, during this period of time, because of the money pumping that was going on during COVID and low interest rates, during this entire timeline, even when media focus was on Russia invading Ukraine, global inflation continues to rise, right? Because don't forget, you could always go back to the educational webinars that were already done, breaking down the pandemic specifically from 2020 onward. We, of course, had, in terms of the US government working in hand with the Federal Reserve, the central bank of the US, the cartel of the currency, increase money supply by 18 trillion, pump the markets through their asset purchase program, keep interest rates at zero to increase lending and investing into the markets by other institutions and corporations down the line. That was all fine and dandy for the rich to get richer, but it comes at an expense and a cost of inflation rising, right? So as Russia invaded Ukraine, this led to an explosion in some asset classes and commodities on top of inflation already rising, such as gold exploding. Oil obviously went a lot higher. But what was interesting was oil was rising through the entire pandemic period, going from minus $40 a barrel in terms of crude oil futures, all the way to $70, $80 a barrel before Russia and Ukraine even hit. Yes, Russia and Ukraine had a more impulsive impact, but oil was already very bullish due to the money pumping, low interest rates, and majority of asset classes having high investment due to the environment set by the central banks around the world at that time, right? So as inflation continues to rise, this is where we entered the most dominant phase of 2022 and the phase that we became most comfortable with, which is dollar domination phase, right? Dollar domination phase basically extended from April, with the main catalyst being this IMF meeting where we had a collective of central bank heads and speakers come together at this one central IMF meeting and all announce a very aggressive rate hike cycle of starting to front load rate hikes to combat the high risk inflation that they created when they were pumping the markets. So here, now in green, all the way until end of October, early-ish November-ish, going into November, this was what we coined in Capital Hungry as dollar domination. Now, what caused the dollar domination? Central banks, more specifically, us talking about the Federal Reserve, flipping monetary policy. Front-loading rate hikes. No more money pumping. Tapering process. And so forth. What those actions by the central banks, mainly talking about the Federal Reserve here, shifting their monetary policy from a loose monetary policy to a tight policy did is completely shift the investing environment. The same reasons before during the pandemic that you had to be buying into the stock market or buying other assets such as gold or oil or real estate, the same reasons that you had for that were now becoming the exact opposite. During the start of the pandemic, when we had those crashes take place, majority of asset classes such as crypto, gold, oil, even the real estate market was at relatively lower prices. You had lower interest rates set by the central bank, making it easier to get loans and pay back those loans and take those loans to reinvest it and get gains on that. And you had the whales riding this wave as well, as the central bank was pumping these asset classes too, right? By the time we come to April 2022, when the Federal Reserve starts to shift into a tight monetary policy, now we have high prices on asset classes. Gold was at $2,000 an ounce. Stock market was at all-time highs. Oil went to $110 plus a barrel. Crypto, Bitcoin hit $70,000 per coin price. You no longer have low prices to keep pooling into it. You have interest rates up, interest rates raising, decreases investment activity, asset classes drop in value, whales offload, right? This dollar domination phase we became extremely accustomed to, because in the example of gold, we understood that as long as the Feds were continuing to front load rate hikes, continuing to talk about rate hikes, continuing to give signal toward rate hikes, continuing to focus on bringing down inflation and dealing with this issue, we knew that there'd be more demand in dollar and less demand in these other asset classes that were seeing so much investment, such as oil, crypto, stocks, and gold, right? Now, this held weight for pretty much the majority of 2022. And the main trigger was really this IMF meeting that took place in April, where you had the collective central banks talk about doing aggressive rate hikes hand in hand. This completely shifted the entire market environment. Now, you just went from this stage where you had the various central banks pumping their markets and pumping their economies and handing out checks to their citizens and pumping up the stock markets and keeping interest rates at zero. And now you have the opposite taking place. Euro Central Bank for the first time is starting to come out of negative rate territory. Bank of England's following suit, front-loading rate hikes similar to the Fed. Fed's front-loading rate hikes. Bank of Canada is doing the same. So the entire investment environment got completely shifted. This held a lot of weight and held enough weight till basically we started to come into November here of 2022. Now, the main catalyst that kept dollar domination alive was weak employment sector reporting. Strong employment sector showing that the economy is strong enough to handle rate hikes, and of course, high CPI is what I meant to say, right? So during this period of time, as long as CPI reports were high, US data solid, labor market solid, that meant Feds will continue rate hikes. Now remember, rate hikes were starting to get front loaded and were starting to increase for this entire duration as the Feds were looking to bring down inflation. As we were starting to approach the end of the fiscal year, this is where we started to get the last phase and what we can see taking place now, which we'll mark out in red here, which is Fed pivot prayers and also recession scares. So remember, the main reason that the Feds never wavered off their plan, they never pivoted, they never shifted otherwise, was because during this period of time from April all the way going into November, we had fundamental catalysts and events that further supported more rate hikes. Inflation reports month after month were still high. Labor market was still relatively solid. The economy was strong enough to continue handling the front loading of rate hikes, and the money markets were starting to adjust this accordingly first, price it in first, well before the rate hikes have even started to impact the economies, right? But as we started to approach November, recession scares globally started to increase even higher, and we saw this reflect with the data as well in terms of US economic data. We had various catalysts feeding into more demand in safe havens and Fed pivot prayer hoax. We had bad unemployment data, bad NFP, improving CPI data reports as well. Now, what this does is as the central bank, Federal Reserve, front-loaded rate hikes during this period of time, the currency interventions are not important enough to mention in terms of macro impact. The currency interventions are something that I was going to talk about at the end that were a part of the dollar domination phase of other countries trying to slow down the volatility of dollar domination. But it wasn't something that held weight through multiple consecutive weeks or months compared to these main sectors here. Does that make sense, everybody? And I was going to talk about that in a second, right? So remember, during this period of time from like April all the way to the end of September, we had aggressive rate hikes in a historical fashion that we haven't seen before. Front loading of rate hikes, consistent rate hikes every single FOMC, and of course, every single Fed meeting, and continued signals of rate hikes. But as this information gets priced in and the market gets adjusted to it accordingly, we had catalysts come into play that started to shift out of that. So one, a lot of the rate hike cycle at this point priced in. Two, also having catalysts feeding into more demand of the safe haven, such as bad US economic data and improving CPI reports, showing that the Fed's front loading of rate hikes was actually having a substantial impact and that the Feds can start to slow down their rate hikes. Otherwise, they're going to topple the US economy and throw it into a spiraling, terrible recession. And what I wanted to talk about now, Alex, was how this also led to fueling the global narrative. Now, what a lot of people don't understand that says stocks bullish, dollar weaker down there, right? Now, what a lot of people don't understand from an economic perspective is, yes, us understanding dollar domination, the change in investment environment, the reasons for dollar domination, and the impact it had, that's all perfectly fine for when we're looking to trade. It was very easy for us to go, okay, during this period of time, I'm going to continue to look for gold sells, pullback sells, breakout sells. I'll play the pullback phases accordingly, but I'm primarily looking for gold sells as long as dollar domination is active. But what a lot of people were ignoring was the substantial impact the front loading of Federal Reserve rate hikes and dollar domination was having on global economies and markets. Emerging countries were getting hammered as their debt was exponentially increasing, business profits decreasing. We saw major currencies get devalued against such a strong dollar. Japan, when you're looking at the Japanese yen, China, when you're looking at the Chinese yuan, to the point that these countries were doing individual currency intervention during this entire period of time to slow down how aggressively the dollar was rising in value, right? And remember that during this time, the Feds had to do rate hikes and other central banks had to do rate hikes inevitably. They had no other option as global inflation was rising, starting to enter high risk levels of 9%, 10%, and could spiral into hyperinflation at a very, very fast and aggressive rate, right? But we can't forget that even though the rate hikes were inevitable, even though the Feds and central banks had no choice, even though it was their own greed that led to inflation being so high, that the stock market did not want to let those gains go. This is why during the entire dollar domination phase, we saw that the stock market was bearish, but was going down in very slow and stagnant fashion as stock market bears goes against the global 1%er narrative. Majority of 1%er wealth or majority of global economics is tied to equity markets. All the corporations' value, the jobs that are connected to that, investment, all of the interconnections through buying and selling, through shipping and import and export, it all essentially comes down to the various companies' values that's housed within the stock market, right? So you'll never really have a stock market crash last for an extended period of time, because if the stock market was actually to truly crash and go to zero, we'd have entire economies crash, no more jobs, no more businesses, no more nothing at all, right? So yes, dollar domination held the most weight for this extended period of time, but we also can't forget from a market psychology perspective that dollar domination was going against the global narrative of stock market bulls and was also causing a lot of trouble for emerging countries and how they're going to pay back their debt, and also larger countries and how their currency was getting devalued against the dollar. Euro dropped below the parity point. Japanese yen extremely weak, with the dollar stronger, and the Bank of Japan with a negative, keeping interest rates in the negative, right? And keeping a loose monetary policy. Even a powerhouse country like China was feeling the heat with their yuan devaluing at an aggressive rate and them needing to do currency interventions, right? So even though dollar domination held a lot of weight, we played it accordingly. This is something that goes against market psychology and the main narrative of the one percenters. They want stock market to be bullish. They don't give a shit about inflation. The greed is a very, very strong thing, right? So as we were starting to approach the end of the fiscal year of 2022, going into the holidays, going into the end of the business year, into 2023, we saw fundamental catalysts that shifted us out of the dollar domination stage and entered the pivot prayers and more of the recession scare stage. We saw Japanese yen picking up more strength during this time. We saw pivot prayers leading to an aggressive stock market rally, where we just started to see it range more recently in the last couple of weeks, and we saw gold start to extend more bullish. This is because a lot of the information of the front loading of rate hikes in the rate hike cycle was priced in during this phase. And also because we had catalysts feeding into Fed pivot prayers, back-to-back bad unemployment rate reports, back-to-back improved inflation reports, showing the Feds can slow down their rate hike cycle and potentially pivot as recession scares continue to widen, U.S. economic data weakens, and there are improvements in inflation where there's no longer needing of aggressive front loading of rate hikes. This led to gold being bullish, dollar being bearish during this time. Currencies globally also having some recovery against such a strong dollar over year, right? Example like Euro USD pulling back from the lows, GBP USD pulling back from the lows, yen picking up a little bit more strength and so forth, right? Now, as we're entering 2023, you can see that our main focus points are still going to be very similar. We're still going to be looking at economic data to come. How is labor market reporting going? How is inflation data looking? As we're coming into this new year, if we don't get any more aggressive front loading of rate hikes by the Feds, if we don't get very hawkish signals by the Feds, if we see that CPI is still starting to trickle down or stabilize, if we see that US economic data is still relatively weak, then we can still see gold be a bit more bullish, with demand as a safe haven and pushing a bit more bullish as dollar still stays a bit weaker. In my opinion, to bring back the dollar domination phase, what we would need to see is the main reason that led to dollar domination and front loading of rate hikes, which is still very high inflation. Now, I personally think that coming into February, after all the holiday spending, after all the extended rallies on these asset classes, that in the fight on inflation is not done just yet, right? I can still see that if we do start to see higher inflation reports still, and the fight on inflation is not done, that the Feds can still be pretty aggressive with their rate hikes and hawkish stance, leading to potentially some moves like this, and then probably just revisiting these lows, ranging, inflation stabilizes, and then gold just enters more of a higher time frame range, right? But this is what we're mainly going to be looking at in terms of next projections here, which we'll mark in white. What's to come? And also remember, the market is always looking for any type of optimism or catalyst to start rallying stocks and to start rallying other risk assets so the rich can get even richer on their investments. This is why every time we had the dollar domination phase, any small rumor of a Fed pivot would lead to an aggressive pullback, or the stock market having an aggressive bearish rally and dead cat bounce before turning bearish again. It takes a lot more for the stock market to be bearish in terms of catalysts and events than it does to be bullish, understanding the real world implications and connections. So if we want to see this type of price formation come back into scene, aka bullish structure starting to come to an end and sellers coming back into play, we would need catalysts that bring back dollar domination. What would be catalysts that would bring back dollar domination? One would be Feds simply saying job on inflation not done and surprising us with more rate hikes to come. Hobie, job not finished. Two would be, good answer there, boy, high CPI report still. Now remember, the last few CPI reports on a macro perspective were showing some signs of improvement, right? Going from like a macro 9% to like a mid 7%, 8% when you're looking at the real data. But the Fed's goal is to bring inflation down to 2%. That's still a very long way to go. It's just that, remember the psychology. Any single little bit of optimism gets taken as a reason for the stock market to rally and for hopes of Fed pivot. So the fight on inflation is not even close to being complete yet. But what we have to start to track is and ask the question is this: did the front loading of rate hikes by the Feds actually have significant impact on inflation? How do we confirm that? Looking at the CPI reports and starting to see it trickle down month over month. 1 month it drops a little bit, next month it stays the same, month after that it drops, and you start to see a bearish trend forming on the monthly and yearly CPI. What this shows us is that the aggressive front loading of rate hikes by the Feds is doing its job, and that they don't need to raise rates anymore. They just need to keep those rates up until inflation drops to their macro goals, which may take a year, may take 2 years, right? 3, if US economic data, mainly looking at the labor market, PMI figures, consumer activity, is still relatively solid, and inflation is still starting to trickle to the upside, What this shows us is that the Fed's job is not finished. And what we were seeing here was short-term shifts in sentiment for these reasons, setting up price from better price points of interest for the institutions in Wales to enter a dollar domination phase and sell gold back down once we get these types of confirms. But right now, we're still having this pivot prayers and recession scares holding the most weight. We don't have any current reasons for dollar domination to come back into the scene. We don't have any aggressive hawkish signals by the Feds. We don't have any signals by the Feds actually having market impact. We don't have high CPI reports yet. We don't have strong labor market data. We don't have strong US data overall when you're looking at PMI figures and so forth. What's currently holding the most weight is recession scares and, of course, potential hopes of Fed pivot, which leads to more dollar bears, gold bulls, and stock market remaining relatively bullish as well, not seeing any substantial crash or downside, and currencies against the dollar holding some more strength. Does that make sense to everybody or no? Right? But obviously, in between here, we had other fundamental events. We had currency interventions. You had like Japan's old prime minister die. You had like people, politicians getting COVID and all these other things. But these are the main catalysts that I see as market drivers for pretty much the entirety of last year and what we're going to expect to see as well. Does that make sense to everybody? So yes, in white, this is something that can potentially happen and come. We can see dollar domination come back into the scene. But once again, do we have any of these reasons for dollar domination to come back into the scene yet? Especially going against the market psychology and main narrative of keeping risk assets relatively more bullish. Do we have any of these reasons yet? Have we had any Fed parrots come into play talking about more rate hikes or Powell giving any signals? Or have we had a very high CPI report again showing inflation's not improved? Or have we had labor market looking solid? Not at the moment. So when we're going to come down to our market update webinar, we're still going to be playing this gold bullish structure, dollar bears, and so forth until we get any confirms of this. If we even do get confirms of this, we could see the next reports that inflation is starting to show signs of continued improvement, right? Now, with 2023, some things that we have to look out for in terms of fundamental catalysts and predictions. China and Taiwan tensions can continue to escalate, maybe even through a physical front. I think Russia and Ukraine is priced in and done. We may see that if it escalates, it only be an escalation if other countries get involved on a physical front, right? But I don't think that's going to happen. I have been starting to see a little bit of trickle effect of COVID making a bit of a return. So that's a possibility as well. But anything can happen. We could even see aliens in 2023. You know what I mean? We've experienced a lot over the last few years that a lot of us didn't think we were going to experience. So if extraterrestrials is the next thing, I wouldn't be that surprised. I'm like, all right, this is pretty normal. It's been a pretty wild 5 years, right? But anyways, never mind the aliens. What I can mainly see is that recession scares and hopes of Fed pivot, that's holding the most weight right now. Things we have to keep an eye out for is if we have catalysts to bring back dollar domination, if we have any escalations with China and Taiwan, and if we have any other geopolitical tensions come into play, which we haven't really had yet, right? Right. So now let's bring this information together and just do another review and recap of the same type of events, but how it impacted other asset classes that we trade. So I'll just retype all this stuff again. We don't need to look at both GBP USD and Euro USD. We could just look at one of them on the higher time frame here, and it'll give us a good understanding. of what was going on. Okay. And you're going to see that it's quite easy to break down and looks very, very similar to gold in that sense. So remember, first phase, going into 2022, where market's a little bit more stagnant, ranging, setting up price for 2022 as COVID priced in phase, right? CB money pumping priced in phase. All right. Now, obviously, from early 2022 into April, this was the Russia-Ukraine tensions. And unlike gold, when you're looking at the example of GBP/USD, this would keep risk currencies like the British pound and euro and AUD and NZD more bearish and the dollar more bullish, even prior to the aggressive rate hike cycle. As any type of geopolitical global tensions, you see more demand drive into the dollar as a safe haven currency and as your global reserve currency. This is Russia invade Ukraine phase. Weaker risk currencies, stronger dollar, stronger gold, stronger yen, uncertainty equities, right? Then you can see we started to see a lot more sharper drops in GBP USD as we had even more dollar strength come into play with the dollar domination phase, which was our favorite phase of 2022, just because it held the most weight for such an extended period of time there. Right? Printing new historical lows, even GBP USD almost entering a parity point, being 1-to-1 with the dollar. Now, a lot of people ask, hey, G, I understand the dollar domination phase as we primarily focus on it with the event of the Federal Reserve front loading rate hikes, right? And I understand that, as you explained in the educational webinars, increasing of rate hikes and a more tight monetary policy or hawkish stance, this is bullish for the currency. But at this same time, the Bank of England was also doing rate hikes. How come GBP didn't hold more strength too? Well, don't forget, the reason why it's called dollar domination is because of how much is globally interconnected to the US dollar, from its uses as the petrodollar, from international business, import and export, investment, and obviously the power as it holds as the world reserve currency. So even though the Feds were doing rate hikes and so was the Bank of England, from an investor perspective of adjusting your order flow into the markets, dollar domination is going to hold the most weight as the world reserve currency and business currency there, right? And now, again, this is something that we understand the market impact, but we also have to understand the real world economic impact that dollar domination led to instability in global markets, emerging countries, and other and other countries' currency values, right? And then this was, of course, going into the end of the year and where we are currently sitting. Right? So as we had those catalysts on the US side of bad jobs data, improved CPI, recession scares growing, end of the fiscal year, new lows printed, higher time frame, we had this shift. Right? Now, when we're looking at GBP USD, this is a similar idea still to gold in terms of what we need to see to shift back into dollar domination. Right now, we're having this of the Fed pivot prayers and dollar domination priced in due to these reasons still holding the most weight. We've still had buyers print these intraday higher highs, and we're just in a pullback phase as we're starting out, of course, the new business year. If we start to come back above 1.22, if we don't have any catalysts for dollar domination, if we don't have any geopolitical fear tensions that weaken risk currencies, such as like Taiwan and China tensions or World War III tensions, or maybe a COVID return or aliens coming down, right? If we don't have anything to take away demand out of the risk currencies, if we don't have anything to bring back dollar domination, then we can still see this phase hold more weight as we wait for more confirms of CPI reports, Fed signals, and so forth. Does that make sense to everybody? Right. Now, this can also be applied to Euro USD here in terms of the same phases in recap. Same type of idea, right? COVID being priced in, winding down 2021, relatively stagnant markets, all that was priced in. Started to get dollar domination come into the scene, or more, started to get dollar strength due to Russia invading Ukraine and less demand in the risk currencies. Then dollar domination came into the scene, March, April there. Same type of reasons for the pullback here, right? Now, what do you expect on USD CAD? Same timeline, but what are you expecting in terms of price movement? Is it going to be the same as GU and Euro USD? The inverse, probably, right? Higher, not the exact inverse, but yeah, around the inverse, right? We come to USD CAD here with the dollar as the primary in the currency pair quote, and the risk currency as a secondary. With GU, it's the other way around. With Euro USD, it's the other way around. And that obviously makes a huge difference. So you can see more of the inverse. Obviously, as we had that ranging, as COVID was winding down, we did start to get UCAD to stabilize more. But how come, this is a good quiz, right? How come even though dollar was stronger here, why wasn't, even though dollar was stronger when Russia was invading Ukraine and the majority of other risk currencies were weaker, why didn't USD CAD specifically just start trending bullish right away? right? We saw that with GU and Euro USD instantly as Russia started invading Ukraine and you had less demand in your risk currencies and more demand in dollar, it was starting to go bearish. Thank you, everybody. Good shit. Oil, right? So this catalyst specifically brought way more demand in bulls in oil, which leads to stronger CAD at that time. So isn't it very interesting, as you had both strong dollar and strong oil, that it printed out a range on the higher time frame here, and you had a lot of indecision? Isn't that very interesting to everybody here? Right? And then as Russia invaded Ukraine phase got priced in, markets adjusted to it, no more new events being brought to the table, no further escalations, oil started to stabilize and drop and correct. And also, what was another catalyst after the Russia invading Ukraine was priced in that led to oil being a bit more bearish? The rate hikes by the feds, right? Taking away demand from these various asset classes that were so bullish, with low rates, rising inflation, investment activity, and the central banks pumping the market. So that's why you can see, as soon as the Russia-Ukraine tensions got priced into the markets accordingly, and of course you had dollar domination come into play with the Fed's front-loading rate hikes, that's when UCAD really started to trend more bullish for the majority of the year there. Interesting, right? The only asset class that is unique in its movement through the majority of last year is US 30. And the reason for that is obviously understanding market psychology, that it's a lot easier for the stock market to be bullish rather than bearish for multiple reasons. One, human greed, and obviously these 1%ers wanting to make even more money, get richer than they are. Two, the interconnection of equity markets to our day-to-day lives, economies, and foundation of the majority of countries we live in, right? So when we're coming here to look at the stock market here, you can see the dollar domination phase was not nearly as substantial compared to the currency pairs, gold, and so forth. But basically, same type of idea here, right? So winding down the end of 2021, going into 2022, the money pumping phase. And what's also interesting is this is when the feds got banned and got a slap on the wrist and weren't allowed to invest in the stock markets anymore, and we never saw that high again. But anyways, so COVID faded phase, money pumping, priced in phase, right? How do you know that? Stock market was no longer printing any more higher highs. As we come into 2022, we had Russia and Ukraine tensions, which obviously is going to bring some uncertainty and downside to the stock market as a risk asset, as you have the potential probability that there could be World War III, that there could be some more physical escalations, that there could be new events brought to the table. Right? You can even see as Russia and Ukraine tensions were starting to get priced in and a dip was created, we even started to get pretty sharp recovery here in the stock market all the way pretty much until April 2022, where then, of course, we had our dollar domination phase. And then, last but not least, Fed pivot prayers. So the reason why I'm copying and pasting and showing you guys this on various asset classes is just to highlight in terms of price movement how order flow is moving in singular fashion during these main phases that you could break down of last year. Does that make sense to everybody? Now, 2023 is going to be a very, very interesting year and very, very unique times from an economic perspective. What do I mean by that? What do I mean by unique times? Well, we're in a very unique point in history where the economies around the world are massive, overinflated bubbles, and obviously just continue to grow larger and larger with the potential chance of a big pop that can come. We're at a very unique time where the stock market is still holding at relatively high prices, but recession scares are developing and inflation is still very high in the US, right? And we've seen exactly the fastest rate hike cycle in history, never seen before during the dollar domination phase and during the front loading of rate hikes, right? So there's some unique things to look out for. Yes, the front loading of rate hikes at the fastest rate hike cycle we've ever seen in history can lead to start to improve inflation and trickle down inflation. But what do we have yet to observe from the rate hikes? We saw the money markets price in the rate hikes. We saw the markets adjust to that accordingly. We're starting to see inflation drop a little bit, but what have we yet to see the real impact of rate hikes to? The economy as a whole, from people's mortgages, their debt rates, their spending activity, and so forth, right? So there could be a very unique time during 2023 where, yes, inflation starting to improve, but the recession is starting to get worse in other aspects of the economy. PMI data getting worse, labor market getting worse, people's personal savings completely depleted, people's debt higher than ever, credit card debt higher than ever, right? So we're going to see this interesting time, and we're going to see how the media and mainstream is going to spin it. As recession scares develop, as credit card debt rises, as the labor market worsens, as consumer activity starts to drop and so forth, and overall recessions get worse and worse, what you're going to see the media focus on is, look, but inflation's starting to improve, right? Before, the risk was, hey, all the data is still good. Hey, man, we don't have a recession. It's just high inflation. Labor market's still solid. PMI data is good. Consumer activity is good. Consumer confidence dropped to record lows, but it's starting to improve. We just have high inflation, right? But now it looks like we're going to start to shift where, yes, we can see the front loading of the Federal Reserve rate hikes start to trickle down inflation, but it's also going to have an impact to the other side of the coin of leading to higher credit card debt, higher mortgage payments, higher loan payments, less personal savings, less personal income, less consumer consumption, less consumer activity, poor retail sales, poor PMI figures, and so forth, right? What I'm trying to explain and say here is, yeah, we may see on improved inflation reports in hopes of Fed pivot prayers, stock market rally maybe a little bit higher. But how long can that delusional rally last when the foundation of the economy is crumbling? Does that make sense to everybody? I still think that 2023, there's going to be a crash catalyst or an economic recession catalyst regardless. Either it's going to be Inflation still through the roof and very high risk, and the Feds can't pivot, or it's going to be that the front loading of rate hikes are going to continue to improve inflation, but everything else is going to go down the drain and get worse and get even shittier for the consumers, workers, and the engine of the economy. Does that make sense to everybody? Even if we see a delusional rally, one more sweep of these highs, the economies are overall dog shit, then the stock market is eventually going to start to translate that, and the investors will have no choice to shift their order flow accordingly to avoid a crash or full destruction. Right? But yeah, very unique time coming out of a historical pandemic, coming out of the fastest rate hike cycle we've seen in history, inflation still high from a macro perspective, global economic data dropping and recession scares getting worse, but still having so much money that the 1%ers and banks and whales have access to, where they're still getting filthy rich. Very, very interesting times. Right? Now, anyways, 2023 focus points. One, any reasons to World War III, aliens. I didn't mean to change the color there, but whatever. At the moment, gold more demand, equities raging on stock market, buyers not wanting to let go of the gains, but not wanting to accept the reality of the recession. The funniest part is, right? The funniest part about the Fed pivot prayers is the pivot prayers is hoping that a recession will take place. So the Fed start pumping the markets again. So they start reversing the rate hikes. So they start pumping the market. But they're not taking into consideration that a recession is also not good for asset classes, the economy. Anyways, they're just focusing on the one side of greed, which is fucking hilarious, right? When you really think about it. But yeah. Obviously, day-to-day economic data we focus on. All right. But right now, this, in terms of how 2023's starting out, we're seeing this still holding the most weight. And we're going to talk about that in the market update webinar. Okay. Yeah, that's a good reminder, actually. So I'll have to do move a little bit backwards here. So we're supposed to do the 2023 focus points at the end, but I forgot to talk about a GJ breakdown here. So basically, GJ at the start of 2022, from the highs, saw a little bit of downside with obviously the Russia-Ukraine tensions, bringing some demand to the Japanese yen, preventing us from going any higher there, even during a Bank of Japan keeping interest rates in the negative, as the Russia versus Ukraine would hold the most weight there. So you had these months where you couldn't break into new highs and then weeks of downside here. But after those events got priced in, we started to see the rate hike cycle holding the most weight. Even after this aggressive liquidity grab and price grab, and then coming into the start of this new year, we have the recession scares, more demand in the yen, weaker US dollar, and that impact there, right? But anyways, everybody, I don't want to make this too long. Otherwise, it's going to take forever to save and upload. And I want to make sure people get a chance to watch this. So I usually want to keep it around an hour max. But that was our 2022 fundamental and economic recap, understanding main market drivers, the timeline that took place. Obviously, for more information, you can watch every single higher time frame webinar from last year, because we do once a month, right? Every single monthly higher time frame webinar, or all the market updates every single week. You can watch those. But that's what we're mainly looking at in terms of what happened during 2022, what's currently going on to start 2023, and how we're going to integrate that into our market updates and trade ideas, which we'll do a little bit from now. Once this saves and upload, I'll just send the link for the market update and trade ideas.